Good morning, and welcome to Hansuke's DAC6 Academy webinar series. This webinar is being hosted in collaboration with our partners, WTS Global. Please do use the chat function on the right of the screen to introduce yourself, and do let us know where you're from. Thereafter, do comment on the proceedings for the benefit of other participants. You can also raise questions for the panel. And should you miss anything, don't worry, we will have access, you will have access to the on-demand recording straight after the webinar. Additionally, the slides can be downloaded. And of course, the events team at Hansuke is ready to help if you contact them directly for any of the materials. I am Ali Kazimi. I am a managing director at Hansuke, and I will be your webinar moderator. I have been in the financial services tax industry for over 25 years, and DAC6 is by far the most technically complex automatic exchange of information regime to date. Today's webinar is particularly of interest to me as I'm currently working on numerous DAC6 assignments in the private equity space. So I'm really looking forward to the insights of leading international experts who are on our panel today. Our discussion today will take a broad look on how DAC6 impacts the private equity sector, including investors, managers, and also implications for portfolio companies. We will also look at how private equity houses go about becoming DAC6 compliant, and we'll also consider the practical challenges that PE houses face in implementing DAC6. We will intentionally not look too deep into areas which have been or are due to be covered by other webinars in the DAC6 Academy series, such as the German deferral, which was discussed a couple of weeks ago, or the main benefit test, which will be discussed later in the series. So we have a really busy agenda. We will round off the discussion with some concluding remarks by a leading private equity tax advisor, Melanie Levy of EIG Partners. With that, I would like to invite our illustrious panel to introduce themselves. So starting with you first, Melanie.
Thank you, Ali. I am Melanie Levy. I am the Global Head of Tax at EIG Global Energy Partners. I myself am a tax attorney. I've been at EIG for about 6 years, and before that was at PricewaterhouseCoopers for about 17. EIG is a US-based private equity fund group. We are an energy specialist fund, and we have offices around the world, including London, Sydney, Rio, Hong Kong, and Korea. We have investors and investments around the world. We really have a global reach, so DAC6 is quite important to us. We invest typically up and down the credit stack, so we have multiple strategies, including kind of straight direct lending. We do mezz debt and structured equity. We also do control equity, so we really do a bit of everything. And we manage both commingled funds and single investor, especially managed accounts. So we kind of cover the span.
So yeah, thanks. Thanks, Ali. Thanks for having me. I'm Thomas Jesch. I'm the managing board member of the German Association of Institutional Investors, relatively new association. And this is not an asset class related association, but we are trying to build know-how to gain more level playing field for both institutional investors and asset managers. And of course, these reporting obligations are quite important for limited partners as well, as we will see. My background is that of a tax lawyer as well. Melanie and I learned that we both attended Georgetown University Law Center and studied tax law there. And as a tax lawyer, both with US law firms and also with PwC, I did quite some private equity related work, and I'm really happy to join you today.
Thank you. Robert?
Yes, thank you very much, Ali. My name is Robert Welzel. I'm a tax partner with WTS in Frankfurt in the financial service team. And I can express WTS. We employ some sort of an international network, WTS Global, and we work very closely together with Ali Kazimi from Hansuke in London, and we work together since more than 20 years in various projects. So it's really, looking forward to learn a lot out of this session here. Thank you.
Indeed, thank you very much, Robert. It's a great panel, actually. I'm humbled. We discovered that all four of us were with Coopers & Lybrand. So that's a great start. We were at a great firm. Two of the panelists studied at the same law school in Washington, and two of the panelists are based in Germany. So lots of parallels. But anyway, with that, I will go to my good friend Robert Welzel to start the ball rolling. Robert, for our listeners, can you start by just outlining what is the overall policy objective of DAC6, and what is the problem that they're trying to fix?
Easy question, quite complicated answer, to put it this way, especially in the area of private equity. To put forward, let's say, transparency, automated information methodologies since FATCA have already been introduced quite a long time ago. So here's the old question was, who received, let's say, ultimately the payments? And this has to be reported by financial institutions. And over the time, it really developed that now the tax authorities are trying to understand what of the payment or what part of the payments is tax enhanced. So they want to understand how the, let's say, returns are generated. And this is especially a topic within the, let's say, private equity industry. From a German perspective, everyone knows it has not always been labeled very positively in the past. So to put it in a broader space, the tax authorities on one side, we are, let's say, they are capital importers, and they typically in the private equity scene, very often the tax base is enhanced, and then the ultimate returns are not, let's say, distributed within the same jurisdictions, but will go cross-border. And therefore, with the, let's say, BEPS initiative, especially Action 12, always the private equity industry has been in the mind of the legislator. I think that is the bad news, but we have to confront, let's say, this here for our discussion and framing the discussion. So tax optimization is a feature of the private equity industry. And with the, let's say, typical employed fund structures, there are many opportunities to enhance also the ultimate, let's say, returns after tax for international investors. And so, plus, and then this is the last remark in this respect, private equity is very much an international business. It is really cross-border, let's say, industry. And the overall framework of here DAC6 is not one unilateral approach, but we have various jurisdictions applying different approaches. And that's really, let's say, we, as an international fund house like IEG, you really face or you have to cope with multiple jurisdictions employing different understanding, potentially different methodologies, and last but not least, many, let's say, players who are addressed by the DAC6, let's say, topic really have to cope with this. Intermediaries, let's say, lawyers, tax advisors, fund managers, of course, and so on. So multi-jurisdiction, multi-involved actors, yeah, that's a problem. How to cope with it. That's a discussion we are looking for.
Sure. So in terms of what we're looking for is some sort of transparency. That's what tax authorities are after.
Yes, exactly.
Fantastic. Okay, so
And
you
when-
raised a number of issues that particularly for the private equity industry. Is it a big deal? And for that, I would like to sort of invite Dr. Thomas and Melanie, if you could sort of just elaborate. Do you see it as a big issue, DAC6 in the private equity sector?
I'm happy to share my experience, or at least my perspective as kind of in-house counsel for a private equity fund. It certainly feels like a big deal. It's, we're a US-based fund with a global reach, like I said, all around the world. And so it's overwhelming to think about all of these multiple jurisdictions with different rules, multiple intermediaries. We manage over 400 entities, about 22 billion in assets. So, there's a large scope to what we do. And as Robert mentioned, we have to think about this both from our own perspective and what we do within the fund to manage our investments, but also, to provide the best customer service to our investors and provide them with what they might need to do the reporting. That said, at the end of the day, my hope is that this really has a low impact. Everything that we do, we think we do for more than just tax reasons. We're not engaging in tax avoidance as we see it. And so hopefully the goal is to make this as low impact as possible. But to get to that place, there's a lot of work we have to do. Thomas, what's your perspective?
I agree, Melanie, because what is the importance of private equity for institutional investors in Germany? Apparently, we're in for a low interest environment. Coming from other angles now during the last few weeks, we see in the European economies, private equity is becoming more important. Always used to be, Ali, I think you agree, in the UK, in the Nordics, but in Germany, we have the same picture. And yes, it might hopefully be low impact in the end, but we have so many structures to discuss. As an institutional investor, how do you go about? I mean, the large pension funds might go alone. The Canadians really have a PE direct team, but mostly they go through funds. If they don't go through funds, they gain experience through fund-of-fund investments. And then there are all these nice variations like parallel funds, side funds, co-investments. How do we deal with those? So yeah, hopefully low impact in the end, not being the direct addressee, but there's some leeway for being taxpayer, being intermediary, depending on the domestic analysis. And that's the other thing, all tax authorities view it somewhat differently. So yeah, a lot of analysis to be done, but in the end, hopefully we both agree that it should be low impact.
And that's an interesting point. And Melanie, if I can just pick up something with you before we move to the next discussion point, is there a sense that this is something that's being done to the private equity industry?
I don't know that we feel it's completely directed at our industry, but it certainly has, I think, a disproportionate impact on our industry as far as needing to evaluate so many different aspects of what we do. But clearly DAC6 extends beyond just our industry.
No, what I meant was really the sense of control. Is it just basically the narrative is being set by somebody outside and you're just,
got it. Yeah. Well, yeah, that's a very important part to me. My goal, at EIG is to manage our tax risk. And one of the things that I worry most about is the fact that these reporting rules apply to intermediaries and so apply to so many people, but I want to control my narrative. I have a view on what we do and the way that we structure, the way that we bring in investors, the way that we structure carry. That again, to me, I don't engage in tax avoidance, and I want to make sure that I can control that narrative. And how do I do that in the most effective way when I have a lot of players that I deal with?
Yeah, and that's a really interesting point. I mean, my own background, I ran the team at BlackRock for about 10 years, and it didn't matter what the issue was, whether it was FATCA or some other thing. It was really important as a house, and I love the term that you use, is to control the narrative.
Yeah.
And that's really important. I mean, if there's one thing we can walk away from today, it's, you have a choice. Either it's being done to you, or you decide on the terms that you engage in the marketplace. And obviously, one of the key ways that a PE house can influence and set the agenda is through trade associations. And for that, Dr. Thomas, if I may just, obviously, the trade associations played such a big role in securing a deferral, which Germany decided not to go down. But that's up to the member state. Do you think that there is a further role that trade associations can play in relation to DAC6?
Oh yeah, thanks, Ali. That's a really good question, and I think I shouldn't only talk on behalf of BII representing institutional investors, but we have BVK, our German Association of the Private Equity Industry, and have already done a number of webinars, DAC6 related webinars, and I guess we'll get engaged along the way, because what do we have? I mean, we have DAC6 and we have the German implementation. Perhaps Robert will talk about that later on. But what we have sometimes is the so-called whitelist. And in Germany, it'll be the BMF circular, and we have already seen drafts of that. But going a little bit back, Ali, to your mentioning, is this sort of an anti-PE initiative? I wouldn't say no, and you can take that from the whitelist, the circular draft, that it really addresses all kinds of structures, tax-related, mostly inheritance tax-related in Germany. So no, but again, we as the trade bodies should really get engaged and cover a lot of ground. As I mentioned, what about co-initiatives? Your platform, go to Luxembourg. Large investors apparently have large dedicated platforms there. How does this play out? So we should become more engaged to lead the discussion, as you have said. That's true.
Indeed. I mean, I think there is definitely, certainly I see a role that trade associations, particularly as there's so much uncertainty, as Robert highlighted, there has to be, I always think of this idea that, airlines do not build runways, and whether it's Melanie trying to sort out her own, establishing protocols, there has to be a role whereby trade associations must bring people together, must create the dialogue or the platform in which people can basically, share the practical aspects of the directive, because the directive is, whilst it gives lots of detail, is silent on many issues. And with that, I would like to just turn the attention to the investors into PE funds, because that's an area that quite often is overlooked, because we look at the fund itself. So Melanie, I know that you're obviously sort of like, it's all about the investors. And so would you like to sort of like lead the discussion there, please?
Sure. Yeah, as I had noted before, investors are our customers. So we need to make our investors happy. That's our goal. And investors clearly have, our EU investors particularly, have responsibilities with respect to this. And so, I'm really trying to delve into that question. There are situations where we're helping an investor structure how they come into our fund. Sometimes we're offering feeder vehicles into our funds. More often than not, we're structuring below our fund and trying to make our fund. I call it tax optimization, but our goal really is to make sure that our investors are in no worse position than they would be in had they made the investment directly. And so, we do utilize a Luxembourg platform, as Thomas mentioned. Many people do. Luxembourg is familiar to our investors. They have comfort there in the legal and the tax system. There are, we have a whole base of qualified professionals there, including people that can kind of work for us and, advise us. And frankly, we need some sort of aggregating platform for our funds. Our funds are quite complex. We have multiple parallel funds that are all coming into a single investment. We want to aggregate them and have, one entity facing our investees. And finally, the administrative burden, if we didn't have some sort of aggregating vehicle in dealing with kind of the withholding tax obligations between a lower tier jurisdiction and all of our investors, would be overwhelming. So we have many reasons that we utilize Luxembourg, but as many people know, there's a question these days as to whether that is a tax avoidance strategy. We feel that it's not, but it's something that we need to consider, and then consider on behalf of our investors who might feel they need to report.
Yes.
And that's an interesting thing, whereby, how do you explain the commercial narrative? Because, all of a sudden you're going via institution. But, I'm just going to go to Dr. Thomas before I get to you, Robert. But Dr. Thomas, I mean, sort of like, you alluded to a number of, domestic structuring, what's your feel? I mean, what's the association's view on this?
Yes, I think the association's view on this, and hopefully shared by the German tax authority, is, as Melanie mentioned, of course, Luxembourg or not only European fund structures per se, but also accommodating to international fund structures. And the good thing is that, what is this? No, sorry. The good thing is that basically, I think the German tax authorities see it in the same light. They see Luxembourg really as a fund jurisdiction, which, based on the stats, it really is. I think it's number 2 worldwide, given the small space it covers on the globus, and it's accepted because you really have all the professionals there, the management. It really has developed quite a number of industry-specific fund structures. I mean, if you remember the C-car structure, right, the RIFE structure, it's really a fund jurisdiction, and it's not primarily a the tax base, because given all these cross-border elements that come into play, it would be hard really to find synergies there. That's, I think, when the German tax authorities would look into a Luxembourg-based structure, a general structure with German investors, they would be okay with that and would accept this as kind of a market standard. So I think that's a good base for international fund structures here.
I'm pleased that both Melanie and the Trade Association agree with each other. Robert, I mean, we've talked a lot about the German tax authority on their behalf. What's your feel as being a leading German tax advisor? Is this something that we'll be able to convince the tax authorities of?
Let's put it this way. I would be a little bit more cautious. We are talking here about, let's say, tax transparency in order to avoid tax avoidance. The clear understanding of the German tax authorities is they are not so much, or because we are talking about legal structures, permissible structures. So if you enter in these structures, there's nothing from a legal or from a tax perspective which has any negative sentiment per se. So the German tax authorities, and it is their understanding, they are asking for, or their intent is to get more information about the whole setup. And what is, from an economic point, quite interesting, first they are asking let's say, there's a broad interpretation of the, let's say, of the DAC6 structure as such, together with the reporting. Let's say you have to add the value of the, let's say, of the transactions, the economic value you have to add to your reporting. And if you, let's say, play this, or if you extrapolate this into the future, you will see a good economic understanding plus the underlying tax transparency. So the jurisdictions are currently building up, let's say, the infrastructure to get more information, and ultimately they have a better, let's say, they are better equipped, better knowledge to make per se decisions. This is also one of the intentions of DAC6. And but as Thomas outlined, from the investor perspective, due to the fact that usual investors are, let's say, not only this would be, let's say, not the right expression here, a limited partner, but they are not running these structures economically. So they are not really addressed to conduct the reporting as such. But this is different, let's say, with the managers in the PE structures, and who are really, let's say, on ground together with the other intermediaries, law firms, tax advisors, etc., in the various jurisdictions. And what is a very interesting, and also from a risk perspective, let's say, topic we have to take into account, probably for Germany, and especially, it is not the reporting as such, but if you, let's say, as a fund promoter or fund manager, if you engage into, let's say, filing the German tax returns for international partnerships, then for the tax returns, usually you have to include all the reporting items. And what is, let's say, the ultimate game from a German perspective and or tax authority perspective, and which has been clearly addressed, they want to understand these structures. They want to get on a playing level field with the, let's say, very sophisticated structures if they apply the tax audits. Currently, they have to run very often complex re-engineering to understand the structures. In the future, these structures will be, let's say, more or less up to a certain degree, they hope for, will be presented. And then tax audits will get a different, let's say, from a quality perspective, will start at a different level. And I think that is also one of the risk items you have to, as a fund manager, you have to take into account. What is the information? Then we really come to the hallmarks and underlying structures. And yeah, it's a very diverse industry, of course.
Robert, I mean, the way I see it, I always work on actors. I mean, sort of like, and no disrespect to Melanie or Dr. Thomas, but quite often the industry, the private equity industry, works in its own echo chamber.
Yes.
They can convince themselves that, oh, this is completely fine.
Yes.
And I look upon tax authorities as generally, and I think sort of like you rightly point out, and it's not divided between Germany or the UK or any other tax authority. Quite often they're generally wanting to understand because they lack knowledge. So of course there is a desire to learn. The wild card for me, Robert, is the kind of decision that you had in Germany regarding the deferral, because there are interest groups and there's politicians, which are far more difficult to gauge as to where the wind is blowing at any moment in time and where they're going to look at. And that creates, because they quite often influence the tax authorities' interpretations. Do you have a view on that, where that is? Because Germany's obviously had that thing, whereas I think in the UK the position is a lot more settled.
I'm not too. Let's put it this way: everyone, also the tax authorities. I'm not here on the side of the tax authorities, but it's typical, let's say, tax risk management. As an advisor, you have to somehow which you have to address. This front running of the, let's say, non-deferral from a German perspective really creates a problem that I think we will talk a little bit later on. How to optimize or how to organize at first hand the communication process between the various players in the various jurisdictions. And so, let's say, at least now, some players in the German market, they will report, and what they will report will set somehow the standards for other jurisdictions within Germany, etc. And so it's, and then let's say...
Robert, sorry to interrupt. I'm not interested in the practical implications. We'll come to that. The question is specifically, what influence does politics have in relation to the tax authorities?
Like from now, I do not really understand your question. Sorry, I'm not native speaker.
So I was talking about, so there's a rule of law that general tax authorities have, yes? Now, do you think that process can be subverted or influenced or interfered with because the way the political parties are going? What's the view in, say, for example, I don't know, Bavaria versus, Mr. Otto and that type of thing? Are you with me?
Yes. The problem is that the wording that we really have some sort of a cultural clash which currently takes place. Let's say this sort of let's say transparency. It's not let's say the typical German view of rule of law, etc. So this is the import of an Anglo-Saxon feature we are currently importing in the German legal environment. And if we talk about the rule of law, the wording is very broad. They are not asking or not addressing specific structures. They are just very broad hallmarks, and there's a learning process and really a cultural, let's say, a process going on how to, let's say, implement, understand these items in the current legal environment. And that is very, very difficult. And from a political point of view, so it is the tax authorities and also some politicians, they learned it gives them a very good tool really to ask for a lot of transparency, to trigger uncertainty. And therefore, due to the uncertainty, many market participants probably will safeguard themselves by a lot of reporting, which, let's say, probably is not the understanding in the UK, as I understand you from DOTA's principles, etc.
Excellent. Thank you very much. That's a really interesting topic. I would love to talk more about it, but I must move on. And you started talking a little bit about the actual fund structure. And, you know, the heart of the issue, I'll just basically put it out there, is the manager's remuneration, which has been so much under the spotlight, both across, you know, in the European sphere, UK, in America. And, you know, what's the view on that, Melanie? I mean, obviously, you have to contend with these issues on a daily basis.
Absolutely. As you noted, you know, carry has been under intense scrutiny. I think that's what we're talking about here is carry. And that, you know, I feel that in the U.S. I know in other jurisdictions, they're looking at it as well. That said, you know, we have the situation where, for example, in the U.S., we now have rules, Section 1061. These are rules implemented in the last few years with tax reform that specifically address carry. You know, the carry that we structure, I view it as, you know, just taking advantage of the rules under our laws, subchapter K. 1061 then comes in and recharacterizes some of that carry as ordinary income. And, you know, they set out straight rules around it. You know, similarly in the UK, I know you have rules that now govern the taxation of carry. So to me, it raises the question, if you have these structures where there are actually laws that define the taxation, you know, would you really still view those as recharacterizations that might meet a hallmark?
Absolutely. And I think sort of like we're with the American cousins on this. But Robert, I mean, sort of like what I've heard in the marketplace is that the German tax authorities will probably still want to, you know, have this reported. Is that correct?
Let's put it this way, from the remuneration structures, if you are, let's say, as I indicated, it's really a question how you will go forward. What is transparency? Is this really a topic of the for the German market or for the German investments? Yes or no? And there you have really to let's say look in detail on the structures per se. Let's say if you take just, and Thomas probably will give some ideas in this respect too. If you just put it from a German perspective, whether you are asset managing or business trading partnerships, that's sort of a check the box type topic. So there's questionable whether really, let's say, carry structures set up on a very international basis outside of Germany, on the backside of some economic investments in Germany, really have to report it for German purposes. I would be a little bit hesitant to be, let's say, to be pro finance authorities oriented.
Sure. And if I can just go further down the chain, we've talked a little bit about investors, we've talked about the actual managers and the carry structures, you know, turning it to the actual portfolio companies, because initially sort of like, again, sort of like I talk, you're within the echo chamber, and we of course say, oh, of course, they're outside of scope for managers. But the way DAC6 is working, the result you get is perhaps a different one, sort of like, and of course, it depends on case to case. But, Robert, I mean, do you have a view as to, how far the oversight has to go? Should portfolio companies be brought in?
I think
in the analysis, the DAC analysis.
Yes, I think, let's say, if a private equity manager really is really in control of the portfolio companies already within the acquisition process, usually, let's say, specific acquisition vehicles are set up for various reasons, for leverage, external leverage, but also, let's say, internal recharacterization of income components, withholding tax optimization. And then one of the goals definitely is to reduce the tax base of the, let's say, target of the portfolio companies. And these are the issues, let's say, which are this, and this is not a specific, let's say, private equity topic. This is the general, let's say, topic if you conduct entrepreneurial, industrial, let's say, business, and you structure this business, then you are within the reach of DAC6 reporting, no doubt about it. And if you combine this, let's say, with loss carry forwards, etc., some transfer pricing arrangements, and so on, in more complex, let's say, typical private equity portfolio structures, and you are in control, very, very likely that you will be covered by DAC6, and you have to make up what is your narrative, as Melanie outlined.
Yeah, thank you. I think that is, I would concur with that. That there is certainly a prima facie sort of like case to be contended with. I mean, people quite often they think about DAC2 CRS, and where certainly at the portfolio level you stopped your analysis. But I think sort of like as you're talking about debt pushdowns and things like that, if you're playing an active role in the construction of the capital base of the portfolio company, I think there's definitely a case to be considered. I would just invite sort of like Dr. Thomas, Melanie, do you want to say anything before we move on and start discussing hallmarks?
Well, I might add that I agree basically with Robert that the German carry structures should be more or less accepted, and there should at least be no main tax benefit, right? So this I heard sometimes from the tax authorities. So we have laws interestingly longer than the US or UK, dealing with the tax regime for the carried interest. So I at least don't see a storm coming up from that end. That's my point.
And I would just note, as I listen to Robert, it just highlights for me that different jurisdictions are viewing this differently, and the extent to which they want information, and that really creates so much uncertainty for us as an organization, or at least effort in needing to understand how every jurisdiction is viewing DAC6 and the sort of position and type of information or extent of information that we are going to provide to each of them.
Fantastic. I know I'm just conscious of time, and I do want to discuss lots and lots of topics. What I will do is, one, you talk about the differences between different jurisdictions, and one of the emergent differences I've seen straight away in discussions with Robert on live assignments that we're dealing with is, the hallmark A, standard documentation, because we have generally got to a point whereby we're pretty comfortable on that. Now, Robert, I mean, there's a slightly different view in Germany on that, which I'm sure is other jurisdictions have that difference as well. Do you want to just elaborate on that?
Yes, if you talk about standard documentation, this usually refers to, let's say, some intermediary, let's say, tax consultant bring up a very good idea, put it into paperwork, and then really distribute this to, let's say, not retail investors, but to many institutional investors to optimize the tax base. And that's a sort of a standard documentation which can be replicated very easily. This was, let's say, the original, and this is the interpretation in various jurisdictions. But from the German understanding, at least within the draft decree, it's still a draft decree, and therefore it's a risk feature. It is not only understood as, let's say, typical standard documentation as a product you replicate, but if you, and this is, let's say, very often the case within the asset management or private equity industry, if you replicate certain structures, if you, let's say, invest into portfolio companies via a fund structure, you usually will employ, let's say, special purpose vehicles, acquisition vehicles, which are the tools to probably to recharacterize income features or to optimize withholding tax features. And if you start this and if you employ these structures, then you are already, or that's a risk that you employ a standardized structures which probably have to be reported. And this currently is one of the risk features, or one of the, let's say, reporting features which varies from the various jurisdictions, but which you have to clearly analyze, because very often, let's say, the typical, not typical, but in a lot of investment features, you will find very comparable, let's say, basic structures, and the tax authorities probably are looking for these structures to be informed and to get knowledge of these structures.
That's interesting. So you've moved from standard documentation, because again, we have the DOTAS where it grew out of, which was what we called shrink wrap type of arrangements, to something which is now you're talking about standardized structures, which is a very big broadening and expansion of where I think even sort of like if you look at the letter of the law in terms of what the directive says, this is very expansive and purposeful interpretation. So that's quite interesting.
And this is one of the risk features. Let's say every private equity house, let's say they have to come up together with their advisors. What is our understanding there of how, let's say, we will report on these topics, yes and no, and to have a clear understanding.
Sure. I know there's quite a bit we had, planned to talk about in terms of hallmarks, and certainly hallmark B is there, the circularity and recharacterization. But just in the interest of time, I'm going to jump that, because there has been a lot of discussion around that within the industry. I think sort of like a bit more, feature of this industry is a lot of people talk about hallmark C. Is that something that we can perhaps look at, which is the deductibility of cross-border payments between associated persons? Obviously, it depends on the facts, the specific facts and circumstances. But, is there a view as to, how far that needs to be taken, given that we have the MBT shield?
So, whom you are? Let's
Why don't we start with you, Robert?
Yes, let's say if you have a relationship, these hallmark C is usually a relationship between related parties, and let's say from the overall, let's say, wording of this hallmark, you're very close to really quite aggressive tax optimization. So if you employ this, you really have at least to look at these structures and make up your mind whether it's reportable, yes or no. I think with hallmark C, we are much more in the area where the straightforward would be yes, more likely to be reportable than in case of, let's say, hallmark standardized or hallmark A documentation and the broadening towards standardized structure, where you have, let's say, much better ideas probably not to report. In hallmark C, very often, even the hallmark C as such, for some very specific items, the main benefit is applicable. In other cases, even MBT test is not necessary at all. You just have to report it. So
and this is the concern that I have, which is it's like the half empty or half full. Which way does a tax advisor look at the structure? Because I think the default position, quite often I'm hearing from advisors is, oh, the moment you've got a debt structure, you're in, and we're looking at a reporting situation. That's not how, perhaps, certainly my discussions with tax authorities have been slightly differently framed. They've basically said nothing is to be reported, the default position, nothing's to be reported unless this hallmark has come in, plus the MBT shield has been defeated, which is a very different way. I mean, it's like, you go to some airports and you push the trolley, and then in order to stop the trolley, you have to press the brake. In other jurisdictions, you have to press the brake or the lever in order to push the trolley. Do you see how we're getting at this? And I'm really concerned about this as to how this whole discourse is being framed in the marketplace about Hallmark C and the MBT. So I just thought I'll put it out there and see what the panel thinks about this.
Yes, from a German perspective, unfortunately, probably I'm here the bad guy. Probably you will be on the more safe side, to put it this way, if you would report and take it. Let's really make up your mind whether it's reportable, yes or no. And even if you do not report, at least to have very, let's say, sound documentation thereof, because ultimately DAC6 is an extension of, let's say, of the general tax risk management system you usually would employ. So you have to make up internally what is your tax policy, how you frame your tax policy, and this transparency reporting item is just another topic within the overall, let's say, for the overall tax positions. And there you, let's say, being a little bit probably coming from a safer perspective, I would say more likely to report, or start with the reporting and then to think about very good reasons why not to report, instead to take the general position, nothing is reportable, only if I get very, very clear indications for the reporting, at least from somehow from a German perspective. Yeah.
You're on mute.
Sorry, Melanie and Dr. Thomas, would you care to comment?
I mean, from my perspective, it really comes down to the MBT and how you view the MBT, and it seems that different jurisdictions may take a different view. We have German investors, both in funds and accounts that we manage, and so we are going to have to think about this from a German perspective and non-German perspective. We don't ourselves have an office in Germany. Our kind of EU nexus is the UK at this point.
Yes, and one remark on this respect: if you're reportable just from a let's say UK perspective, of course, as an intermediary or as a reportable, you would apply, let's say, the UK interpretation, and that is from a reporting perspective, and then plays in probably that, let's say, the German investors are just let's say, the so-called users in Germany, the relevant taxpayers. And if they do not get the information, they do not have to search out for additional information, but you report solely within, let's say, the framework of the UK, you are on the safe side. It might be a little bit different, let's say, if you have specific German investments on the level of your portfolio companies, but that is then another topic.
Yeah, I mean, I think there's definitely as much tax discussion that's going on as much as a cultural discussion, because I mean, sort of like, I go to, I was saying to someone the other day, when I'm visiting Amsterdam and I see that they have no curtains in the front windows, and you can see right through the door, right through the house, and you see people talking, eating, and it's really odd, because we're just not used to seeing anything like that. So I think this idea that you just spew loads and loads of report seems, somewhat indulgent on part of of us to basically burden the tax authorities with so much information. Whereas I think what I'm hearing is the default position is report as much as you can, because that's the way to protect yourself. So as I said, it's which end of the telescope do you want to look at things? And I'm sure there's very good, verifiable, venerable sort of like tax analysis can be done to support both positions. But I think we're now getting to a practical situation, which you sort of like said, who bites, or which part of your nexus gets caught by the tax authority, and which one first. Because if the Germans are basically racing ahead, they're now forcing the rest of, essentially telling the rest of the, depending on how obviously your fund footprint is, but the Germans are essentially forcing us into reporting on their terms rather than perhaps the UK. Would you have something to comment on that?
If I would start, let's say, even if the Germans, apply now, are the front runners, this really complicates what we addressed a little bit in the beginning. You have to, and Melanie probably may talk a little bit more about it, to coordinate the communication between the various parties, which are here usually involved in a typical PE situation. So the fund manager, let's say with Luxembourg funds, and administrator and fund manager in the UK, but then you have the lawyers, tax advisors in the various jurisdictions on specific, let's say, tax optimization topics for portfolio companies, etc. How to coordinate the different interpretation of the various jurisdictions to come up with one, let's say, report from to coordinate at least the communication to the tax authority. I think that is, from a risk management perspective, very, very important.
Sure. I think that, this is a really interesting discussion. We have had, Hallmark C, we went and discussed MBT, and Melanie said, look, that's the shield to use. And we will be having a discussion in a couple of weeks' time, just what the MBT means, because there is no uniform understanding even on that. So, how much of the shield you can use. But, you raise very good points, Robert, which is about what are the practical side of things. So, Melanie, I'm going to sort of I'm just conscious of time. I'm going to invite you to talk about how does one become compliant, and any sort of wrap up, takeaway points that you might have for our listeners.
Sure. I mean, I think it's very clear from this conversation that there's a lot of uncertainty in these rules, and the breadth is overwhelming. When you're a global fund like ours with, as a global reach, intermediaries all over the place, how do you really address this? And as I noted, my goal in managing tax risk for my organization is to control the narrative as much as possible. So, we're really focused on how do you take all of this information and kind of cut out the noise and come to a practical approach to how you actually report. So we're actually working with you, Ali, on this. We're ourselves trying to take that role of intermediary. That's our first and foremost, is as much as possible can we serve as the intermediary. And then we want to take our own view on what we think is reportable and not reportable. And so we're taking the breadth of our whole firm, that includes both our firm, our portfolio companies, our funds, our carry, and we're breaking that into pieces. So we basically say, let's find representative structures in each of those realms. As has been noted in this presentation, I mean, we often do replicate structures because that's what makes life administratively simpler for us. And so we really can choose representative structures, and let's really analyze each of those representative structures as to what our position is on reportability or not. And then let's boil it down to a practical process. And my hope is that when we go through all of this, we'll find that there's a much smaller subset of what either is reportable or needs to be analyzed on an ongoing basis. And then we'll document our position on all of these things. And then finally, we're taking this on within our tax group because we want to obviously come to the position and the view on what we think should be reportable. But ultimately, this is going to involve more people in my firm than just our group. And so then we'll have to coordinate within our firm as to how we actually get the reporting done. But again, it's trying to get through the noise, balance all of the risks and what's reportable and what's not reportable, and come to a really practical approach.
Yeah, and I think that's probably the key thing is the term they use is how to operationalize, because there has to be a very clear view of what the end looks like. The end goal must be, because otherwise, we could be here for another 3 years still discussing. We could write academic books on this and still not come to a conclusive view. One thing that before we go is always worth, and a sobering thought, if I may ask, is, Robert, I mean, one of the issues or challenges is, there's consequences of getting it wrong. They're fines. Do you want to talk a little bit about it? Because they vary across Europe as well. I mean, UK has been very kindly sort of like said, oh, we'll slap on £5,000, and which initially we were thinking, gosh, that's very high, because normally we used to fines of about £300. So that seemed very high to us. But I think Europe has a different view on this.
Let's say for the backlog, there are in Germany, for example, no fines at all. Going forward, the maximum per missed reporting item may be up to €25,000. But let's say this is not, from a German perspective, usually not, let's say, the what is always, let's say, fined. This is just a legal, let's say, ceiling. But nevertheless, you have reputation risk you have to comply with, or you have to take into account. And from a, let's say, penalty perspective, other jurisdictions, as far as I understand, like Sweden, Netherlands, and especially Poland, are much more, let's say, I really put it this, aggressive than Germany here in this respect. And even Luxembourg has a much higher, let's say, top penalty rate. But whether they will apply it is, of course, a different. It's of course different. So there we also see, at least from a penalty perspective, very different pattern throughout the various jurisdictions.
Yeah, I mean, some of these rates do look quite draconian.
Yeah.
You mentioned Luxembourg. I mean, they're talking about €250,000.
But whether they applied might be different. Let's say.
Yeah, of course. But I mean, at least sort of like as a headline number, that's a big number to have. Yeah. So, but what I wanted to do was just any final thoughts before we go?
I can just share mine. Go ahead.
Please go ahead.
No. Yeah. So thanks, Melanie. I just want to stress that I don't see such a huge danger of a German front running. Ali, what you mentioned, of course, given the timeline now, might look complicated, but I think the German tax authorities are well aware of the basic, it's not a rule of law, but of the basic principles that limited partnerships in the area of private equity are tax-free, that there is a carried interest structure that is there for decades. And I don't think that Germany now wants to impose additional reporting requirements on the whole of Europe, at least, or other players that go through Luxembourg structures mainly. Yeah. I don't see such a danger. So we come to the very first minute of your introduction, really stressing there should be more discussion. We should really bring across the technicalities of this specific industries and discuss it with the tax authorities. That is really essential now, given the short time span. But I think other than that, no really punishing initiative per se from the German end, if Robert agrees.
Sure. Thank you. We've come to an end on our time. Melanie, do you want to add just one few seconds?
Yeah, I would just say, as again is clear from this discussion, this is that is a very broad topic and could have extensive application and present a really significant administrative burden to a fund group. So really key is going to be getting through the noise, coming to a view that balances tax risk, and then actually getting to a place where we can do some reporting.
Fantastic. You've been a great panel. Thank you, everyone. And thank you to our listeners. We do intend to continue the DAC6 dialogue. We at Hansuke, in collaboration with WTS, are leading the DAC6 discussion for the financial services industry. Do join us for future webinars. Here's a list of them. And with that, I just wish you the very best for the weekend and stay safe. Thank you. Goodbye.